Hello, clients and friends. This is Craig Llewellyn from U.S. Investors International, and it is my pleasure to present our second quarter economic review. As you watch this, please keep in mind it is a review of the months of April through June, so we'll give some updates through today, which the Federal Reserve has just announced again that they're keeping rates steady. So we'll talk about that a bit as well. The Trump administration started the third quarter with a bang as the One Big Beautiful Act bill became law on July 4th. We will briefly review some key items on that bill, and we'll share more specific details of that act in the near future. We're just currently learning more and more about that, and we'll continue to do that in the next couple of months ahead. A lot of stuff in that bill, and some of it's a bit complicated. At our firm, we partner with clients and believe an educated client is our best client. While we always try our best to help you when it comes to your finances, we believe that knowledge is power. One of our missions is to share with clients any knowledge that can better help them make an informed decision. If this past quarter and the first half of the year are not a testament to a long-term investing philosophy and staying in the course of a well-diversified plan, then we are not sure what is. If you left planet Earth on January 1 and returned on June 30th, you would see that the S&P 500 started the year on a high note and achieved a new high on June 30th. This is great news for investors who stayed the course. However, if you had sold out of the market when many others panicked in late March or early April and tried to time a re-entry point, you could have missed some of the quick upward move. As the charts show, the second quarter kept investors on a roller coaster ride. The good news is that after early April, when President Trump placed a 90-day pause on trade talks with many countries, including China, equities made a strong rebound. By early May, the S&P 500 regained its year-to-date losses and entered positive territory for the year. After advances of approximately 5% in both May and June, the S&P 500 closed the second quarter at all-time highs, leaving investors who stayed with equities feeling joyful once again. The S&P 500 closed the quarter at a record high of 6203.31, up 10.57%, and posted its best quarter since December 2023. The Dow Jones Industrial Average closed the quarter at 44,077.26, up 5%. For the year, the Dow Jones Industrial Average is up 3.6%. And that holds true pretty close to today, as the market had hit a little bit higher in mid to late July, and now here at the last part of July and this last week, we've had the market, I think, is in a bit of a small correction territory. We get these 3 to 5% corrections when markets get frothy and the prices get high compared to the earnings. So we'll see this. The Consumer Price Index is a key statistic used to measure U.S. inflation. It has slowed considerably since it surged to highs in 2022. As of May, the year-over-year CPI, otherwise referred to as inflation, was measured at 2.4%, which was slightly higher than April. The June numbers released in early July showed overall inflation still reasonable at 2.9% increase year over year, but core inflation had slight uptick for the month of 2.7%. Overall, inflation is still trending in the desired direction, and as of June, the tariff impact has been slight, if at all, and that holds true here through July as well. According to economists, the big concern is whether any of the tariffs levied by Donald Trump will reignite inflation in the coming months, and obviously we will continue to watch these results as we move forward. Moving over to interest rates, the Fed closely watches economic activity, which continued to expand at a solid pace during the second quarter. It's also continuing in the third quarter, as we've learned today. The unemployment rate remained low and labor market conditions remain solid. That's still the case through July. However, inflation concerns because of tariff implications during the second quarter of 2025 caused the Federal Open Market Committee to maintain interest rates in the range of 4.25% to 4.5%. As of today, through the July Fed meeting, they're in the same position, though two of the Fed board governors dissented from that decision. They wanted to lower the rates by a quarter of a point. So September will be interesting, and will really depend on how these numbers, inflation and unemployment, in the next 2 to 3 months, how they come out. None of this news affected investor sentiment, and stocks remained steady following the announcement. Though today, I think, again, the market hit highs in July, and I think we're we're in the midst of a little of a pullback here. And I think after today's news where the Feds aren't going to raise rates, we saw the market come down again. So wouldn't be surprised to see 3 to 5%. That would give us another 1,000, so another 900 to 1,000 points off the Dow. Wouldn't be surprised to see that here. And frankly, it would be healthy. There are still 4 more meetings scheduled for 2025 for the Federal Reserve. However, until the trade policy is finalized, even if the labor market remains strong, a holding pattern for interest rates could remain, though the Feds are saying cuts, two cuts this year. They're still saying that as of today. But for now, the Fed indicated that rate cuts are, again, still possible this year, but that remains contingent upon, again, the inflation and the economic conditions. So a lot of uncertainty still. Bonds are considered a choice in lower quality, but even they were not exempt from volatility in the second quarter, and they remain sensitive to continued uncertainty. The 20-year Treasury note started the quarter yielding 4.56% and ended the quarter at 4.79%. The 10-year note started at 4.17% and ended at 4.24%. The outlook for bonds in 2025 remains unclear. There is still uncertainty about inflation and interest rates trends. A big player in determining the direction of inflation and interest rates will be getting more clarity on tariffs. Again, so far, the tariffs have not impacted inflation. If down the road they do indeed decide to lower rates once or twice this year, this will be good for the bond market. So we consider using bonds when they are appropriate for portfolios. And when we do, there are several things we take into consideration, including your risk tolerance, the time horizon, overall investment goals. The safety comes with a cost, and even though interest rates have risen, many major banks are still offering lower interest rates to savers. According to Barron's, the average bank money market rate on June 30th, 2025 was 0.39%, and the average 12-month CD rate was 1.76%. As you can see, they have decreased over the last 12 months, providing savers who take this route with even lower returns. If anybody's interested in exploring better sources for interest rates, please let us know. We can shop these CDs around, and we're getting better rates than these. But if interest rates keep coming down, it'll help the bond market. You'll see more money coming out of savings and into more bonds and interest in equities with dividends is usually what happens here. We want to remind you that we encourage long-term investing. As you examine a 45-year chart of equity returns, we are once again reminded that over a 40, 30, or 20-year time frame, even with some very severe downturns, historically, long-term investors have been well rewarded. As we move into the second half of 2025, here are some key takeaways from the second quarter. The S&P 500 recovered from correction territory and once again set new highs. U.S. inflation continues to decrease. It was 2.4% in May, down from 3% in January 2025. The federal funds rate range remained at 4.25 to 4.5%. As of June, the Feds are still forecasting rate cuts in 2025, but as we know through July, they still stayed at 4.25 and 4.5, still no cut. The unpredictability surrounding tariffs continue to be a key player in the direction of inflation and interest rates, though at this point we're seeing that they are not impacting inflation. So volatility in equities will continue. Again, we'll see markets when they get excited and they hit new highs, they get ahead of where their price to earnings are. And so then we get these smaller corrections, which again is very healthy for the market long term. We will continue to provide you guidance on any issue we feel may affect your personal situation. Maintaining a well-devised, long-term focused plan has historically served investors well. And finally, remember that we are here to discuss any questions or concern you may have, and especially as we come into third quarter reviews here coming up in not too long, starting in August, September. Let's talk about this economic update on we know this is an economic update, but we want to talk about the big, beautiful bill that was passed on July 4th by President Trump. We will be sharing information as we finish analyzing this bill, but here are a few items within this bill that can impact you. The currently lower tax breaks will remain, which this is really important, that we've been enjoying some of the lowest tax brackets, and that would have been a big deal if we'd have lost those. So that's a huge part of the bill. The Tax Cuts and Jobs Act income tax brackets were going to sunset at the end of this year, but now these brackets are now permanent and saving millions of taxpayers from a tax increase. Higher standard deductions have become permanent. The higher standard deduction becomes permanent will increase to $15,750 for single filers, $23,625 for head of households, and $31,500 for married individuals filing jointly. In addition, there is a new additional standard deduction of $6,000 for those over the age of 65 that will last through 2028. With this bill, one of the things we're finding there's a ton of income phase outs for this in this bill, and this is one of the areas that will be some things we need to be watching there if we're doing Roth IRA conversions. Things like this will impact that. So this will impact a lot of our clients. We'll really need to be watching tax returns here in the next couple of years and really watching what we're doing here because we don't want you to miss out on some of these deductions. State and local deductions, known as SALT, is raised from $10,000 to $40,000 with a 1% increase in the cap each year through 2029 before returning to the $10,000 limit for 2030. The deduction is reduced for higher income taxpayers, starts to phase out after $500,000 of income. The estate tax exemption was increased from $13.99 million to $15 million for individuals and from $27.98 to $30 million for those married filing jointly. These new laws have some limitations and guardrails that we are currently analyzing. We are planning to address the details behind the changes that impact our clients and future communications. Again, I don't know if I've ever seen a bill with so many income phase outs in this. So I think this bill gets more complicated as we learn more about it. So we're going to be learning hard here in the next 2-3 months. There's a lot for us to work on here, but we want to end this update by once again thanking you for trusting in us. One of our main objectives is to keep our clients informed, and we appreciate you taking the time to watch this update. Please feel comfortable sharing this update with anyone else you think can benefit from this information. Hope you have a great rest of the summer, and hope you're having a super day.